Thank you, Raleigh. Appreciate the introduction, and thank you to Trading Pub for hosting this afternoon. If you see the title, Axiom Strangles, I understand that we have a fairly knowledgeable group. Familiarity with options. For those of you that are real familiar with options, you might be thinking, well, a strangle, that's kind of basic. I'm not sure I'd be interested in this. Well, I want to assure you that if you hang in there till the end, you're going to be very surprised, because this is a twist on strangles that I really don't think you've seen before. I really feel this is something proprietary that I've come up with. I've been doing this for a while, had a book published on it, and nobody has come forward and said, oh, we were doing that long ago. So until somebody comes forward and says they've seen this before, I'm going to continue to say it's proprietary. If you don't have a lot of familiarity with options, it's not so in-depth that you'll get lost. There's some basics in there. So long story short, I think we've got something for everybody here, and that this will be something that you'll want to consider in your own trading as we move forward. So what you're going to learn is, as Raleigh said, how to profit without forecasting market direction. And that sounds great, and there's a lot of theories and strategies out there, but they tend not to work as well as strategy really is pretty amazing, and we do not care what direction the market goes. We just want it to move. We will do a basic comparison between straddles and strangles. Don't trade straddles. I'll explain to you why. Don't trade basic strangles either, but trade what we call axiom strangles, which is a little bit of a twist on a strangle. It all comes down to the Greeks, and if you have familiarity with options, you know that you've got to understand Greeks. To be a successful options trader, they're crucial. And delta and gamma are big parts of this, as well as some other pieces that we'll cover. We'll talk about the best trading patterns. There's several different trading patterns that can yield a movement in a stock, but we have some that are favorites. I'll go through why, and also how to find them early. I think that's important to everybody. The shorter period of time we're in a position in making money, the better off we are. Just wanted to show you, this is a equity curve. Started doing this with option axiom, and give you a little bit more of my background. Raleigh gave me a pretty good introduction here in a couple minutes. But started doing this for option axiom, which is my own business, back in January of 2012. If you had a $10,000 model portfolio or $10,000 account, this is the equity curve just on this strategy alone. So I think you can see that it's pretty impressive, especially when you compare it against the S&P 500. So if you had any reservations of whether this would be not, hopefully this is something that will open your eyes a little bit more. Again, Raleigh gave a pretty good introduction. Let me just fill in a couple pieces, if you will. I was a golf professional for nearly 13 years, and everybody always says, former, why would you ever leave being a golf professional? If you play golf, you know weekends and holidays are the busiest times at any golf course. I didn't have a lot of time to do anything else, and I love golf, but there's other things I like doing as well. I started my own financial services business. The transition away from golf and how money worked interested me, but when I started to work in the financial services business after getting a securities, insurance, mortgage, all the licenses that you needed, I realized that, God, I really didn't like having a boss. So I started my own independent financial services business, but you're so trained on just pure fundamentals and creating an asset allocation plan, and I noticed that no matter how well you followed the mold, if you created this wonderful asset allocation plan, if the market went down, clients still lost money. And I remembered options from my securities licensing process, and they seemed interesting to me. And I educated myself through doing events like this, learning from others, and realizing that, boy, options are where it's at, the ultimate low risk, high reward strategies. But then I was dismayed to find out that not only did broker dealers not want you to trade options for your clients, they didn't want you to do it for yourself either. And I just thought that's crazy. So I literally walked away from my financial services business, handed it all to another advisor that was in my firm, and just started trading options on my own. There were several of my financial services clients that said, wait a minute, what are you doing? We still want to follow you. So I would just say, okay, well, I would let them know what I was doing. I began as an independent contractor, traveling around the world with some of the top financial education companies on options, and found out that, boy, I was hearing that an awful lot. People like, hey, we just want to follow along with what you're doing, and that's where Option Axiom was born. So that gives you just a little bit of a brief rundown of who I am. I know you don't really care about that. Let's get to the important information. Well, when we're talking about a straddle or a strangle, it comes down to the two most basic things that you can do in the world of trading options, right? Buying a call, buying a put. So when we buy a call, we have a risk graph that looks just like this, where we have unlimited profit potential. Stock moves to the upside, no limit to the amount of money that we can make. But if the stock moves to the downside, there is a limit to what we can lose. So we know what our risk is moving in, and we have unlimited profit potential if the stock moves to the upside. Again, if you're familiar with options, I know you're like, I already know all this stuff. Well, hang in there. It gets better, I promise. We also combine that pardon me, with buying a put. And that's the opposite, where we now make money if the stock goes down. However, it's not unlimited profit potential to the downside, is it? Because there's a really strong seal, a little strong floor down there at zero. Stock can't go below zero. So that's a pretty good level of support. But I like to use the word substantial. We can make a substantial amount of money if the stock moves to the downside. Technically not unlimited, but we can do well, still maintaining that same limited risk if the stock moves to the upside. So we have potential in a call, unlimited amount of profit if the stock moves higher with limited risk. In a put, we have a substantial amount of potential gain with limited risk as well. Now when we put those together, we get a very interesting looking risk graph. I would imagine you're familiar with risk graphs. If not, the vertical axis represents profit loss. The dotted line through the middle is the zero line. Anything above that dotted line is profit. Anything below it is risk or potential loss. The horizontal axis down at the bottom represents the stock price. And you can take a snapshot of a particular price range, or just in general, you would assume that down at the bottom where the two lines meet, that would be zero. And then as you move to the right, you have unlimited potential movement to the left. So from zero to infinity, basically, on the horizontal graph. So if we put on the long call risk graph and then combine that with the long put, we have the basic straddle risk graph. The neat thing about it is you can make money if the stock goes up, you can make money if the stock goes down. Where's our risk? Where's the one time that we don't make money? If the stock doesn't move, right? That's where that red V is below the zero line. That's the risk. Risk graphs have to be drawn at a finite period of time. So most of the time, risk graphs are drawn at expiration. So this is showing you if the stock didn't move all the way to expiration, you would lose what you paid for both the call and the put. Obviously, the stock moving is key. However, contrary to what some people believe that don't fully understand risk graphs and realize that they're drawn at expiration, if the stock moves sooner, and that dotted line there, the curved line, looks more like a U, represents now, meaning that from the point that you put the position on, if the stock begins to move to the upside, you make money. If the stock begins to move to the downside, you make money right away. It doesn't mean that the stock has to move a considerable distance up or down before you start making money. And that's what some people incorrectly believe in the world of general straddles. Here's the key. Delta. I mentioned that we're going to be talking about the Greeks. This is what really is the crux of the strategy and why it works, and a little bit of a twist that we're going to put on it. And we haven't even gotten into a strangle yet. I'm just giving you the straddle. We're building things up, and we're going to get to a really amazing climax here in a little bit. So the delta is the amount an option value will change as a percentage of the stock movement. By definition, that's what delta is. Let's take a look at an example. Let's say we have a stock that's trading at 20. We don't want to go pay $20 a share for buying the stock. The reason we buy options in the first place is because they cost less. So we go buy a $2 call option. It's going to be an at-the-money call, so we spend $2 to buy the call. The stock price then moves up $1. So the stock itself goes from 20 to 21. The call option moves from 2 to 250. On that movement, a 5% movement in the stock, right? The stock moved from 20 to 21, so that's a $1 move in the stock. So a $1 move in a stock trading at $20, that's a 5% move. What percentage did the option go up? Well, you could make a case for either 25% or 50, couldn't you? Because the option moved from $2 to $2.50. So a 50-cent move in the option is a 25% move in the option. But when we're talking about delta, what's the correlation? The correlation is the amount the option moves compared to the stock movement. Remember the definition. So in this case, the option moved up 50 cents, the stock moved up $1. So the option moved half, or 50% of the movement in the stock itself. So you go buy an at-the-money call, you're going to make 50 cents of the very next dollar the stock moves. And that's key to remember with delta. Delta is the amount the option will make on the next dollar movement in the stock. Once the stock has moved $1, you now have a new delta. And that's, again, moving into the key of what we're going to be talking about and the exciting part of this strategy. There are several different ways to learn. You can learn verbally, orally. I'm a visual learner, visual spatial. I actually took IQ test and I scored 100% on the visual spatial part of the IQ test. And I'm not trying to, I don't want that to sound egotistical, but I did. I scored 100% on that part of the IQ test. I'm not that smart of a guy. I just think that I'm doing what I'm supposed to be doing is my point. And if you're not familiar with what the visual spatial part is, that's where you see a pattern, they show you a pattern, and then you have to predict what's the next step in the pattern. So being a technical trader and relying a lot on chart patterns, I think I'm doing what I'm supposed to be doing in life, and that feels pretty good. Well, you can go out on the internet and take a look at the mathematical formula for delta. It's a convoluted mathematical formula. I took all the way through calculus in college. I didn't do very well in it, and I don't understand the mathematical formula. But I can look at a visual picture of the delta curve and understand it a lot better. You can see it looks like kind of a lazy S. So down at the bottom left represents 0 in delta. The upper right is 1 or 100, depending on how you view it. Usually we talk about 0 to 100 in the world of delta. But it's the nature of the curve that's so interesting. We talked about a straddle where we were buying an at-the-money call and an at-the-money put. So as far as where a straddle would be on the delta curve, it would be right smack in the middle of that curve where 50 is, or 0.50, however you want to view it, as far as the delta. So you buy the call, you buy the put, both at 50 on the delta curve. Now in the straddle, what do we want the stock to do? We want it to move, right? So once the stock moves, one of the options is moving in the money, moving up the delta curve. The other option is moving out of the money down the delta curve. Now this isn't representing moving to the upside or the downside as far as the stock. This is the option moving in the money or out of the money. Now notice they're moving at roughly the same speed, right? Those arrows are at roughly the same angle. And that means that the option that's moving in the money is making money at roughly the same speed that the option that's moving down the curve or moving out of the money is losing money. So if you're kind of offsetting, if you're making money about the same speed, you're losing money. And this is one of the issues with a straddle. It's a legitimate complaint that, well, the stock has to move quite a bit before you start making a sizable amount of money. We showed you can make money immediately, but it's small as far as the initial movement. You do need a decent amount of movement. And I think that's a fair criticism with straddles. Now, what do? Well, you look for stocks that are more volatile. What's the offset? Then the options become cost prohibitive, and it just, it takes away from the nature of a general straddle. Well, you know how they say you do your best thinking in the shower? I've done a lot of seminars around the world, and I say that all the time. And almost invariably, when I say that, I get a blank look back from the audience. And apparently, I'm the only one that's heard that expression, but I know I heard it somewhere. Somebody said that. But I was literally in the shower one day, true story, thinking about this. This is how warped you become when you get really involved in trading options, thinking about options and trading all the time. But my thought was, in visualizing in my mind the delta curve and the issues that are involved with the straddle. And then if you take a strangle is just going one strike out of the money on either side of the stock price. So you're not moving where you are very much in a traditional strangle, at least the normal way you describe it. There's just one strike out of the money either side. Yeah, it costs less, but you're still in roughly the same boat. But what if we were to buy both of the options down here, right at what I call the profit sweet spot in the delta curve? And that happens to be around the 25 to 35 delta, 30 being the absolute sweet spot right in the middle of that highlighted area. Now, we're not always going to be able to find options with a 30 delta on both the call and the put. So you have to have a little bit of range, hence the 25 to 35 is the area that works. But what if we were to buy a call with a 30 delta and a put with a negative 30 delta, right? Because we know with deltas, if it's a call or it makes money as the stock moves higher, the delta is represented as a positive number. If it's a put or something that makes money with a downward move in the stock, the delta is represented by a negative number. So if we buy a positive 30 delta call and a negative 30 delta put, we're still delta neutral, which is the fact that we don't have to pick a direction, but we're changing where we place the strategy on the delta curve. And why are we doing that? To take advantage of the math. It's a fixed thing. It's math. It's how it's calculated. So let's buy these down here at this point on the delta curve. So now once the stock moves, one of the options is moving almost vertically at that point on the delta curve in the money, where the other option that's moving further out of the money, you can see has a much softer curve. It's almost a horizontal movement. Well, in theory then, wouldn't it be that the option that's moving in the money is moving in the money much faster than the options moving out of the money, meaning the option moving in the money is making money faster than the option moving out of the money is losing money. So in theory then, this should profit faster than a straddle or a traditional strangle. And again, at this point in time, it's nothing more than pure theory. Visualize along the bottom, if you will, that horizontal line on a risk graph which represents the stock price. And note that if you're looking at a price down along a horizontal line, it's not on there, but just in visualizing in your mind, and you see how vertical the delta curve is moving up, that represents very little movement in the stock. In other words, the stock doesn't have to move a lot for that one option to be gaining momentum quickly, the delta increasing quickly. Now we're moving into gamma, right? Because gamma is the speed the delta moves. So that's part of this process as well. Delta is how much an option will make or lose on the very next dollar a stock moves. Gamma is the speed in which the delta moves. So we're taking advantage of both of those in this strategy. So here it is in theory. So I'm in the shower and I'm thinking about this. I'm like, yeah, this makes sense. So I got to go test it out. So when you have a theory, what do? You have to put it into practical application and see if it pans out. So here was the
Hello.
risk graph of a straddle. People have their negative views on straddles due to the fact the stock has to move a lot or the cost if you're dealing with a more volatile stock. Then we look at the risk graph of a strangle, and what have we done? We've taken some of that risk out, haven't we? The lower part of that V, the bottom part of the V, we took some of that out. Why? Because we're paying less by buying an out-of-the-money call and an out-of-the-money put, one strike out of the money either direction. We're spending less, but now if the stock doesn't move relatively soon, you can see that by the fact that the upper arms that are representing the profit to the upside or downside are showing that the stock now has to move further. So a lot of people criticize a basic strangle by saying, well, sure, you're paying less, but now you need the stock to move even more. I might even rather pay more if I can make money a little bit faster. Neither one of them are a very good scenario unless we change the way we create this strangle and put it on the profit sweet spot, which is what I just showed you on the delta curve. Okay, let's show you some examples. Take a look at this. Here's Google. Now remember, one of the issues with trading Google would be the expense. And if you look, you'll be able to see on the screen that's going to come up with the pricing, that this was done back in 2008. You might be thinking, why are you showing me an example from 2008? Because this was the first trade that I put real money in. After thinking about this and creating the strategy in my mind and the theory of it should work, I did back testing. It panned out in back testing, but then we have to put real money at work, right? So this was the first actual trade that I put real money in. So I'm always going to have this in my presentation because it has, some special meaning to it. You can see we have a beautiful symmetrical triangle. That's one of the patterns. We'll get to the patterns in a little bit, but that's one of the patterns that I really like as far as a breakout. And for those of you that are candlestick charting fans, look at that last bar, a doji. So we have a beautiful symmetrical triangle, a series of lower highs and higher lows, and we have a doji right near the point of the triangle. So we have some indecision. Pretty good time to put on a strategy that was going to make money on a breakout move of the stock. I think you would agree. So if we take a look at this, we say, wow, if you were to buy a regular straddle, Google was trading at 680 at the time, buying one 680 strike call and one 680 strike put. It's going to cost you $7,045. $7,045 for one contract of a straddle. Obviously, one of the issues with a straddle, the cost if you're dealing with a stock that can actually move. If we were to put on the Axiom strangle, the one I've described to you, we would be buying a 750 strike call and a 630 strike put. Well, what's one of the things you notice right away? Oh, wait a minute, these two strike prices aren't equidistant from the stock price. Remember, a traditional strangle is going one strike in the money, one strike out of the money. In that example, you are equidistant from the stock price. Here we're not. We don't care what the strike is. What we want is the delta. We want that positive 30 delta call and the negative 30 delta put, or as close as we can get to those. So in this instance, just simply looking down the option chain, where's that positive 30 delta call? Boom, it's the 750 strike. Now let's look on the put side. Where is the negative 30 strike put? It's the 630 strike put. So the call is 70 points above where the stock is trading. The put is 50 points below where the stock is trading. Hence, they're not equidistant, but we don't care. We want those deltas. Now look what happened to the debit, $26. One contract of this strangle is only $2,600. It's a whole lot better than the $7,000 we're going to pay for the straddle. And if you're thinking, well, that's still too high, just hang in there. This is the first one I did. I'm going to show you some with lower price stocks. It works the same way. Now, a lot of people would say, okay, yeah, you're saving a lot of money. You're only paying $2,600, but look at the strikes. They're 120 points apart. Google moves a lot, but it isn't going to move that much. You're still going to lose your money, even though you're not paying as much. So what? If you're paying less, if you're going to lose it all, what difference does it make? But watch what happens. Google drops $28 the first day. What is supposed to do out of one of these triangles? And it does. The straddle that we paid $7,045 for makes $495. You might be thinking, that sounds pretty good to me. But look at the strangle. The Axiom strangle that we only paid $2,600 for makes, are you ready? $590. And at first blush, you're thinking, how can that be? It can. $7,000 in the straddle to make $495. We only paid $2,600. It's still only one contract, and we made $590. That's the power of the math and taking advantage of the Greeks and how delta works. So let's look again. The next day, Google drops again. Awesome. The puts are in control because the stock's breaking to the downside. We move further to the downside. Obviously, we made more money, right? Well, in the straddle, now we only have $390 of profit. We gave back $105 in profit. Now, how's that possible? Well, there's other factors involved, like implied volatility. Google dropped $28 the first day. It only dropped 8 the second day. Was it as volatile the second day as it was the first day? No. So what do you think happened to some of that implied volatility in the put options? Took it out. So even though the stock moved again the same direction, we actually gave back part of our profit, and that's because of, I'm sure you're familiar with this term, volatility crush. Big drop, small drop, change in volatility. But watch the strangle. The strangle actually made another $15. You might be thinking, well, $15, what do you do? But it's a lot better than losing 105, isn't it? Why? This as affected by the drop in implied volatility. Because where is implied, what are you more susceptible to changes in implied volatility? On at the money options, right? And that's where we are with a straddle. But with this strangle, we're well out of the money. We're not as susceptible to changes in implied volatility. So where the straddle actually gave back $105 of the profit that we made, we actually made $15 more in the strangle. We're paying less and making more. I don't know about you, but it kind of sounds like a win-win to me. Next day, Google drops again. Straddle's now made $885 in profit. We paid $7,045 for one straddle. We're now up $885 in profit. Again, sounds pretty good. But the strangle that we only paid $2,600 for has now made over $1,000 in profit. So in the straddle, spending $7,045 and making $885 in profit is a 12.5% return. And again, in a few days, you're thinking that's not bad. Angle where we only paid $2,600 and made $1,090 in profit, that's a 41.9% profit. Which would you rather have? And we haven't even talked about the fact that, all right, if you're willing to put $7,000 in one trade, you'd have to have an awfully large account to do that. But if you were, what could you do with the strangle? Buy more contracts, right? And then you're multiplying the amount of profit by the number of contracts. So now, I mean, I'm thinking, all right, here we go. Everything worked in theory. Back testing worked. Now real money, it's working. So let me show you some examples where we don't have to spend quite as much money. The benefit of a strangle, less cost, less risk, faster profits. Again, all those things are win-win because remember, in any sort of a debit position, what you pay is also your risk. So you keep the cost down, you're lowering your risk. And we're generating profits faster, and we're generating profits faster because all we're doing is taking advantage of the math, the way things work, repositioning the trade on the delta curve and taking advantage of how delta acceleration or gamma works. All right, how do we find these things? What are the patterns? Well, we want patterns that are going to yield breakout moves in the stock. And there are several. There are flag patterns. There are pennant patterns that people look at for breakouts. I like the wedges or the triangles. Those are my favorite. I tend to stay away from the other ones. 99% of the trades that I use this strategy on are triangles. Now, the first one we have shows a stock price that moves up, hits a price level. Aren't these cool graphics? Got a great support team. Stock goes up, hits a particular price level, comes back down, goes up, hits that same price level, comes back down. So we're finding some resistance at a particular price level, but every time we come to the downside, we're making a higher low. So an ascending wedge or ascending triangle is a pattern where you have the same highs and higher lows. It's going to break out. Which way? Most people look at this and say we're going to get an upside breakout. The data just doesn't show that. The data shows that it can break to the upside or the downside almost equally as often. So you can't just kind of hedge over to the fact you're going to get an upside breakout. Sometimes, yeah, the pressure building from those higher lows forces you through that resistance. But other times the resistance holds and the breakout is actually a move lower. We can also have the exact opposite pattern where we have a stock that goes down, finds a particular price level, and bounces up. Comes back down, finds that particular price level again, bounces up once again. So now that bottom line, the horizontal line, as we're going down and finding that same price level low, what's that called? It's a support line. So we come down, we find support. When we bounce up, we make lower highs. So this is known as a descending wedge or descending triangle. And if you ask most people, they'll say that's going to break to the downside. That pressure is going to come down and force its way through that support line, and you're going to have a big downward move. But again, the data doesn't support that. The data says, yeah, that can happen, but it can happen almost equally as often that support holds and you get an upside breakout. So my point is, don't hedge on which direction you're going to move. And then finally, the same pattern that you saw with the Google example, the symmetrical triangle, where here the price is just ping-ponging back and forth, making a series of lower highs and higher lows. And this is one where most people concede, you got no idea which way this one's going to break. Nor do we care. You know, and I say that, but if you really cared, you know, could we really care? You could say our stocks move to the downside faster than the upside. So if you're going to make me pick one, I'm going to pick a downside breakout. Well, watch what I'm about to show you. I think you're going to find that interesting. But with a symmetrical triangle, it can go either way. And if I did have to pick one, the symmetrical triangle is my favorite. But it's not to the point where I only put trades on symmetrical triangles. They all work, but I would prefer this if I had a choice. Here's PBR. And I know some of you are out there thinking, yeah, well, Google broke to the downside. You picked a great example because it broke lower, and we all know stocks go down faster than they go up. Well, I mean, it is true. Stocks go down faster than they go up. But we're making our own volatility in this. And this is an upside breakout. So watch this if you're thinking, yeah, because there's always people that are naysayers, right? PBR, as you can already tell, is going to break to the upside. We have another beautiful symmetrical triangle, pattern of lower highs and higher lows, and there's that doji again. I don't want to make it sound like you always have a doji in the point, because you don't. But if you do, hey, indecision right at the point of breakout, never a bad thing to add into the mix. Now, if you were going to put on a traditional straddle, you'd be buying the 34 strike call. The 34 strike put's going to cost you $2.99. I told you that we'd get away from spending $7,000. You don't have to do this on super expensive stocks. Again, it's just the first one I did with real money. If we were going to put on a traditional strangle, where you go one strike out of the money on the call and the put, that's the 35 strike call and a 33 strike put. And you know what's so great about where we are now in the world of trading options? So many stocks have single dollar increments. When I first started doing this, trading this live money and sharing this back in 2008, well, at that point in time, there weren't as many stocks with single dollar strikes, and it was a little more challenging to match up the deltas. Now it's so much easier. The universe of positions that we can find is vast. So you end up trying to pick the best of the best instead of just finding enough to occupy the trading account. However, remember, with the Axiom strangle, we're not just putting on a traditional strangle, one strike out of the money either way. We're looking for the 30 delta. And in this case, that's the 36 strike call and the 32 strike put. So now we can compare the straddle, a traditional strangle, and the Axiom strangle where we're taking advantage of the delta. So there's the upward move out of PBR. The straddle generates $7 in profit. Paid $2.99, so $300 to get in, you're up $7. And you look at the traditional strangle, we lowered our cost, $211. That's better than $300, isn't it? And you make $6.50. You make almost the same amount of money. But look down here on the Axiom strangle. Look at our debit, $1.42. Less than half of what you would have paid for the straddle. And look at the profit, $7. We made the exact same amount of money that the straddle did, and we paid less than half to get in. It's amazing that this exists, isn't it? Spending less, making more. PBR continues its upside breakout. The straddle's up $31. Now remember, we paid $300 to make that $31. The strangle that we paid $211 for makes $30, almost the same amount. The Axiom strangle makes $27.50. Not quite the exact same amount of profit, but we paid less than half. and made almost as much. Another upward move. This is the beauty of these patterns as you get these big vertical breakouts. The straddle now up $83 after paying $300 to get in. The strangle that we paid $211 for makes $79.50, and the Axiom strangle we paid less than half of the straddle is up $71.50, still generating a nice gain on a lot less money. Stock moves up again. Straddle's up $150. The traditional strangle's up $143, and our Axiom strangle makes $129.50. So we're lagging a tiny bit on the profit. Again, we have a lot less money at risk, and if you wanted to put $300 at risk in a trade, you could have done 2 of the Axiom strangles. Now we reach our breakout target, and it's amazing how often the stocks hit the target because there's a formula for how far the stock's going to move on the breakout. So on the last move, the straddle's up $167, the strangle's up $159.50. The Axiom strangle is up $145.50 on less than half the money. So let's look at the scorecard. The straddle that we paid $300 for generated a 55.9% gain. Not bad. The strangle that we paid $211 for generates a 75.6% gain. Even better. But the Axiom strangle that we only paid $142 for makes 102% profit. We almost doubled the profit that the straddle made on half the money. Again, spending less, making more, and for the naysayers that say, it's because the stock broke to the downside on Google, there you go, there's an upside breakout. Another question comes up is, does this work in any market condition? It works except in times of really high volatility, like if the VIX is up at 60, like it was in 2008 and 9, yeah, the options are going to be pretty expensive. You might not want to do that because you're risking a big drop in the VIX. But other than that, when you have just a normal ranging VIX, it works great. Even when the VIX is low, when there's not a lot of volatility in the market, you might be thinking, well, if the volatility is low in the market, do you still get these breakouts? Yeah, the beauty of the pattern is they generate their own volatility because they get these vertical breakout moves, either up or down, regardless of what's going on with the VIX. I have a scan that identifies these opportunities. And boy, this is a great example of why this is important. This is on Baidu. Look at this. So we have an ascending triangle and an earnings report out on the horizon. A lot of people feel that they can put on a straddle the day before earnings. They think they got this figured out because we all know earnings reports move stocks. I'm going to put a straddle on right in front of earnings, especially with a stock that's volatile and moves a lot, and then they just can't understand why after the earnings report the stock moves and they don't make money. Well, here's why. Watch the reasoning why. So this is when the scan identified this opportunity. Earnings reports on the horizon. It's not tomorrow. It's out there on the horizon. The strangle, buying the 99 strike call, 78 strike put, costs $7.33. So it'd be $733 to do one of these on Baidu. Breaks out. Nice move. Couldn't be any better. Worked exactly the way it was supposed to, and we generated once again over 100%. $733 to get in, $737 of profit. Nice 100% gain. Now watch what happens to Baidu following the breakout. What does it do? It consolidates again, this time in the symmetrical triangle, right in front of earnings. And you're thinking, perfect, I'm going to double dip on this one, right? I got one nice profit. Now I got another one setting up. I got the earnings report coming out. Oh, man, this is beautiful. Watch what happens. I want to make sure that I'm very clear. The scan did not identify this opportunity. We did not do this one. We did not send this one out as an alert. We didn't do it. Here's the reason why. Watch. It breaks out after earnings, and in fact, that breakout actually was higher in the price movement than the one that we did put on. This one would have cost $1,040. Now that's your first telltale sign. Why is that one so much more expensive than the other one was at $733? What? The stock breaks out even more and we lost money? That position would have generated a loss. We knew that. That's why the scan didn't identify this opportunity, because one of the primary factors, along with the delta and the gamma and everything else that we've talked about, you must consider implied volatility. One of the factors in the scan in identifying opportunities is the implied volatility must currently be low. Look where the implied volatility was on the first position, the one that the scan identified. Look where the implied volatility was on the second one, where the stock moved into a symmetrical triangle right in front of earnings. The volatility was much higher. Well, we're not the only ones that know that earnings reports move stocks. Everybody knows that. So the implied volatility factor is key. As you're moving into an earnings report, the implied volatility goes way up. And what happens the instant that earnings report is announced to the implied volatility? It's like a vacuum. It's gone. Notice that drop. And it's not like at 9:30 when the market opens, you got a couple hours because of volatility. No, the volatility is gone the moment the market opens. So in this case, we had volatility working in our favor because we got the breakout. The stock was moving vertically up. They added volatility. We had the action, the little carrot on top, or cherry on top, if you will, of the fact that earnings report was on the horizon. Volatility was beginning to move up as well in addition to our breakout. But the key factor on the reason that second position lost money, even though the stock broke further in price points than it did in the first one, is the volatility crush, the big drop in volatility. You can't ignore implied volatility. So you can see one of the keys is that we don't do this right in front of earnings. Our scan will not identify opportunities where the implied volatility is too high, because you can have a stock make a great move and still lose money. And that's the last thing that we want. So when we compare the Axiom strangle to traditional straddles or traditional strangles, either one, we have less cost and therefore less risk, and we generate faster profits. We spend less and we make more. That's how we were able to generate that equity curve. It's based on this movement. And the scan identifies the opportunities, the triangle patterns. Part of the criteria that goes in is a key indicator that lets us know, and nothing's 100%, and this isn't 100% either, but quite often we have opportunities where the stock is right on the cusp of breaking out because of one of the indicators that's included in the scan. It's just when it reaches a certain level, it's like warning, warning, we are about to move, the stock's about to break out. It's great when that happens. Go look at OXY. That's the most recent one. It's pretty amazing on the breakout. That actually occurred on the Friday after Thanksgiving. You can see we're in that one for like 2 days. So it finds all the key criteria. The explosive moves, again, that's how that equity curve was able to be generated. Nothing is better than testimonials. This is obviously not indicative of all the positions, but every now and then you do get tremendous breakouts. It's pretty amazing. So that in general is the strategy. I see that there's a lot of questions that have been coming in. I want to make sure that I get to the questions. We do have a special offer just for Trading Pub. For those of you with Trading Pub, if you're interested, I have a weekly outlook too that's free, that I cover what happened in the previous week in the market, and we talk about clear, concise market analysis and tell you what's really going on. I don't have any ulterior motives. That frustrates me on the financial networks where you have people coming on there and everything is great. The economy is wonderful and employment is wonderful, even though our participation rate is at historic lows and the jobs that we're adding are all in service sectors, and we're adding part-time people because employers want to avoid having to pay Obamacare. So there is a link here that if you're interested in being a subscriber, receiving the alerts on these Axiom strangles, you can click on this link. It tells you more about it, and I know that's an awful lot of stuff, so what we did is we created something that might be a little easier to remember. It's optionaxiom.com/tradingpub. So if you go there, it will take you to this exact link. So if you have any issues with that link at all, just optionaxiom.com/tradingpub. Now make sure that you go through this link if you're interested, because there's an offer here specifically for you guys that's a lot less than what's on the website. Love to have you follow along with us. I think the timing is ideal. We're moving in towards the end of the year. We have low volatility from a VIX standpoint, because there's an expression, don't short a dull market, never short a dull market. And that means because trading is thin. But what's the alternative to that? When you have thin trading, moves get exaggerated. So even though you might think moving into the end of the year, well, that wouldn't be a great time because there's low volatility in the market, maybe in the market in general, but not on individual securities. When they break out, sometimes at this time of the year, they break out even more due to the fact that trading is thin. There's not as much liquidity. So that works out really well. And then when we come back in January, January last year was one of our best months. Look, you can see how the market moved in January. And so I think January and February are going to be a bit more volatile again. So I think the opportunity here, the timing, really couldn't be much better. So thank you for listening, and I'll get to as many questions as I can here. I saw some of them coming through. Forgive me, I wasn't ignoring you. It's just I found out as I get older, and I'm one-track minded, so stay on the presentation, and then I'll come back and answer the questions. First question is a great one right off the bat. When do you take profits? I mentioned briefly that there's a formula. When you have these triangle patterns, and here's the actual math. When you have the triangle patterns, you measure from the mouth of the triangle. That's the wide part, not the point. And so where's the high, where's the low? So how far is that price-wise? Here's the statistics, at least from since the time I've been doing this. 75% of the time, the stock is going to break out the same price distance as the mouth of the triangle. So let's say if you're finding where's the high in the mouth of the triangle, where's the low, and that represents 10 points of price movement. The high to low is 10 points. Well, 75% of the time when the stock breaks out, it's going to break out 10 points. And then just wait. I mean, it's like it hits a ceiling or lands on the floor. It's like, boom, it just stops right there. It's amazing. And go look at the chart of OXY. It hit the target on Friday. Look what happened the past 2 days. It hit the floor. We sent the alert out. We closed it. Boom, boom, yesterday and today, both days back to the upside. It's incredible how they hit the target, and then that's the end of it. However, 90% of the time, the stock is going to break 80% of the mouth of the triangle. So if the mouth of the triangle is 10 points wide, 90% of the time, it'll move 8 points on the breakout, and that's what we tend to follow. And the reason for that is that's where you get the highest benefit from implied volatility, because that last little 25% of movement, when it breaks out, the last piece of that movement tends to be slower. In other words, you get the big vertical move, and then it just kind of creeps up the rest of the way. Well, once it starts creeping, what happens to the volatility? It comes down. So by delta, if you have the price move in your direction more, you make money on the delta. But if the volatility is dropping, it offsets that, and you tend not to make really that much more by hanging in there for a further price movement. Sometimes the stock actually moves further, but the position makes a little less because of the drop in volatility. All situations are different, but in general terms, that's what we follow along with. So that's how you know when to take profits. Another question is, how far out in time? Well, the ideal point is 45 to 60 days. Well, why 45 to 60 days? I think everybody knows the 45 days, because you start to get less than 45 days, what's your enemy? Time decay. We're buying an out-of-the-money call and an out-of-the-money put. We have time decay susceptibility on both of these sides. So time decay is an enemy. Hence another reason why we want to find these opportunities as close to when the stock's going to break out as we possibly can. And then you might think, well, okay, well, that's fine on that, but why limit it to 60 days? Wouldn't 90 or 120 days be even better, because it gives you more time for the stock to break out? Well, we have to be careful, because what's the key element here? The speed of the movement of the delta, which is gamma. Gamma is higher the closer you get to expiration. So if you start going too far out in time, you end up really shooting yourself in the foot because now you're offsetting the gamma. Now the gamma's dropping down so much that even on a breakout, you don't make as much. So the 45 to 60 days, that's the sweet spot as far as how far out in time to put these on. The delta range, you can't always find an exact 30 delta call and an exact 30 delta put. So if the net delta is somewhere between -5 and +5, in other words, what I mean by that is if we buy a 30 delta call and a -30 delta put, that's a net zero delta, right? Absolutely perfectly delta neutral. But let's say the call is a 32 delta and the put is a -27 delta. What's the difference? 5. So that's on the one end. It's a +5 net delta. And the reason that we keep it as a net -5 to +5 range is if you go outside of that, you're starting to get directional. And as Murphy's Law would have it, right, as soon as you start edging one direction, which way is this actual breakout going to be? It's going to be the opposite direction, isn't it? It's just the way things work. So we want to still make sure that we stay non-directional. We don't care which direction it goes. So we need those net deltas to stay between -5 and +5. If you just go out looking for the triangle patterns and you put on all the triangles, you're going to be disappointed. You'll get some that work, but you got to take other things into account. The net delta has to work out, and sometimes you can find a great pattern and the volatility is low, but you can't get the deltas to match up. You've got to walk away from those opportunities. If it's not following the rules, then you're setting yourself up for a potential losing position. So make sure that we follow the rules. Do these work for weekly options that have considerable gamma? You're thinking, so that's a great question. I wouldn't do it on 1 week. You can try to go out on a weekly for a couple weeks, but the issue that you're dealing with is you need it to move right away. There's a lot of risk there, so we tend not to do that on the weekly options. But I like the way you're thinking because you're on the fact that those are going to have the fantastic gamma, but you need it to move really, really quickly. If you wanted to experiment with that and fool around with it, I would say if it doesn't break in a few days, get out. But we don't do alerts on weekly options for that offsetting reason, which is the time decay. Yeah, in fact, you commented on your own question as far as using the weekly options. Will this work for options on futures contracts? It works on anything that has options. So if you have options, if the deltas match up, volatility is low, yeah, you can use it on any optionable security. We even do it on ETFs. And you might think, this ETFs, they don't move as fast. How you be surprised? Take a look at them. One of the best, GLD. GLD consolidates, breaks out, consolidates, does it all the time. And you will start to find that over time that for whatever reason, certain securities tend to consolidate and break out and consolidate and break out. And you might not think that an ETF would be an ideal candidate because they don't tend to move as fast, but boy, GLD does, and some of the other ones. And a couple of you were asking the questions about weekly options. Comment, you got to watch option prices close to earnings. They're inflated and overpriced. Exactly, that's what we were talking about. Pump up the volatility moving into earnings because everybody knows stocks move on earnings reports. At least quite often they tend to. And some of you were following along, and this is a knowledgeable group. For one thing, when I was asking you questions throughout that, I can see the answers were really good, and uh, also the thought process on the higher gamma with the weekly options is really good reasoning. Comment, you could have bought an iron condor and done well. Well, maybe if you want to work for the volatility crush on that, I tend not to get into those. I stay really purely to the strategy, go by the if it ain't broke, don't fix it type of a mentality. So I've had just tremendous success with these. It's amazing how often they work. Good question would be, well, what if the stock doesn't break out? You know, what do you do then? Sometimes you will get, and we look for a confirmation in the breakout. I mean, this is actually going to lead me to another point. Sometimes the stock will break out, and a comment will be, all right, well, if the stock breaks to the upside, why don't we take the puts off? Let's just take the puts and ride the calls. That way we're going to make money even faster. We don't have to worry about the loss that's occurring in the puts, and then we're making money quicker. You have to be careful because there are false breakouts. We look for confirmation of the breakout, and then we really, very rarely do we take one side off. We do at certain times when it's, there's enough premium to warrant it, when it's absolutely positively confirmed that you're breaking out in one direction. But false breakouts exist where it'll break one way, but then the big move is actually the opposite direction. Let me give you a quick example here. It's a horror story. I was doing a seminar in Orlando, and a gentleman came up to me and he's like, well, I trade straddles. So he was really interested in this, right? Because he was a straddle trader, and he said, you talk about not taking one side off. Here's what I did. He had put a straddle on a drug company that was undergoing FDA review for a new drug. So nobody really knows exactly when the FDA is going to make a ruling, right? But a couple days before the expected ruling, the stock broke to the upside. So his thought process was, aha, somebody knows something, because we all know that no information ever leaks out, right? I hope you note the sarcasm that was stated with. So he's thinking somebody knows something, information's leaked out, the FDA is going to approve this new drug. So what did he do? He took off his puts and doubled up on his calls. He's going to hit a home run on this trade, right? I mean, he put a ton of his account on this one position because he was convinced that something had leaked out. Well, you know how this is going to end, right? What'd the FDA say? They did not approve the drug. The stock tanked. He didn't have the puts for the downside, and he wiped out a big chunk of his account on that one position. So we have to be careful. There will be times when we take one leg off, but very careful about that. And there has to be enough premium left in the option to offset the commissions and make it worthwhile. But it doesn't happen very often. Quite often we'll just ride it. And then, usually the breakouts, or quite often the breakouts are so fast that you just close the whole thing out. Now there is one instant where, let's say you get a massive vertical breakout and your profit's made. The option where the stock broke out, you've made your money there. The other option's worthless. Well, you close out the option that you made the money on, and the other one's a lottery ticket. We had one position where it broke out quickly. It was an upside breakout. We took the call off. We had a nice gain. No reason to close out a worthless put. Just hold the put, and if it breaks fast enough, you might have a whole month or so for the stock to reverse back down, because from a technical standpoint, on these triangles, when you get a breakout, they eventually retrace the breakout. It's usually not fast enough to help us, but sometimes it is. And in this case, we added 30% to the profit of the position by holding the put, because we got a big vertical breakout. And sometimes when stocks go straight up, what happens? They come straight back down, right? It's like a rocket. Rocket goes up, runs out of fuel, it's going to fall back down. And so the put regained value as the stock came back down, and we were able to sell the put then after the fact. And again, that added 30% to the profit of the position. So there's a lot of different things that happen. Those are rarities. I don't want to make it sound like that happens all the time where, we're manipulating and taking one leg off and holding the other. But all these things do occur, and there are instances that we can take advantage of when they show up. The time frame for the trades, it looks like I've answered a lot of these questions. What percentage of the trades work versus those that fail? As it gets me back to the question that I was going to, I get off on a tangent, apologize for that. But Does every stock break out within the original time frame? No, what'll happen is you can get a stock that breaks out, and a confirmation is when you have two vertical moves on good volume. So in other words, if it breaks to the upside and you break out of those trend lines, it has to close higher the next day on good volume. That's a confirmed upward breakout. Well, sometimes you'll get one that breaks to the upside and then the big move is lower. Well, then sometimes you get one that breaks to the upside, it comes down, it breaks below the lower trend line, and you're thinking, okay, the upside was a false breakout. Now we're breaking out to the downside, but then that one's not confirmed either, and it moves back up. And what's happening here is the pattern wasn't finished. It's actually building a larger triangle. And so you have maybe even as much as a couple more weeks where it goes back and forth and it makes a larger triangle than the original one that was identified. Well, in the end, that's a great thing for us because the larger the triangle, the greater the expected breakout is. But if it doesn't happen in a time frame, the position starts to reflect a loss. So we will, in that instance, we will roll that out and give it another month, give it more time if it's reflecting the fact that it's actually creating a larger triangle. Why would we want to walk away from a position just because it's currently reflecting a loss if we know that it's going to break out eventually anyway once it finishes the position? So there are times when we will do that. But as far as the ones that fail, it's such a small percentage of those that will create one of these classic triangles, the ascending, descending, or symmetrical triangles, and then not break out. You just look at charts. They just don't do it. They just don't go into one of these triangles and then flatline. It's just extremely rare when that happens. So the issue that does occur sometimes, though, is you have a triangle, breaks up, breaks down, goes back and forth, and you're like, I see what's going on. We're building a bigger triangle. We're going to roll that one out. We're going to give it more time. So maybe the current position reflects a loss, but once it eventually breaks out, we recover that loss, and we still make a nice gain. In that instance, you might not make quite as high of a profit, but you still generate a profit. And instead of just saying, it's a loser and walking away and taking a loss, if you've got a great triangle pattern, let it do its thing. It's what it's supposed to do. Why do I call it axiom? Somebody actually looked at the definition of an axiom and sent me all this kind of stuff and all. And just to be honest with you, when created option axiom is just trying to come up with a cool name. There's so many things that already have option in the name. There aren't that many of them, and I just kind of thought it was cool. The logo that we have, my son is really good in graphics and stuff, and so I mean he created that logo where you have the curve breaking through the trend line going through the A and all. It just kind of all fell in together. Um, that's the reason, honestly. Profit loss on taking trades. Well, you saw the overall for the portfolio in general. We normally a low end profit's about 30%. You saw a few examples that make 100%, and that's about it. That's about as much as you're going to get out of them. So the average profit on these runs in the 40 to 60% range. Sometimes it's a little bit lower. Sometimes if you get a huge breakout, but you have to get the 100% ones and all, you need a lower dollar stock that makes a big run. It happens. Those are a smaller percentage of the time, but 40 to 60% consistently is what you can expect. How much does it take to open an options trading account to trade comfortably? Boy, that's a wonderful question too. We try to keep, you can see that we start with a model portfolio of $10,000. We have people with much larger accounts. We have people with smaller accounts. And we do have an auto trade agreement with TradeMust, not promoting any brokers whatsoever, but there is an auto trade feature if you're interested. Not everybody has access to, we send out our alerts through text message and email, but not everybody can, run to their computer throughout the day. We all doing different things, and so there's a choice to where they can actually put the alerts in your account, and you just let them know what percentage you want. So if we're sending out an alert based on a $10,000 account and you have a $5,000 account, then you say, I want to do half the contracts. I'm going to do half the contracts of what the alert says. But the specific answer is we try to keep them around $500 to $600 per position. That's what we try to keep the risk around $500 to $600, and you can generate nice gains off of that. Any adjustments? Do I use stop losses? I don't use stop losses, and the reason for that is when I started my options trading career, I found out that when you use stop losses, um, what happens quite often? You get stopped out. And so I'm not saying I'm against stop losses, but you use mental ones. If you hit a particular point where you're like, that's as much as I want to lose on a particular position, then go in and close your position out. I'm just not in favor of the online set accounts that let you put it in there because the floor traders can see those. And even if you use it as a contingent order, the floor traders aren't supposed to see that. I just, I'm a little bit of a conspiracy theorist, and I still see people do that. They get stopped out. So I'm more of a fan of, if you have a particular risk threshold, then go ahead and close it out physically without necessarily already placing the order and having a contingent order sit there. Because you have to remember, the floor traders, they get paid, right? Anytime they execute a transaction, they get paid. And you just see weird things happen. I mean, have you ever been stopped out of a position where as soon as you got stopped out, it reversed back the other way? Isn't that frustrating? And doesn't that make you wonder? I mean, isn't that like, come on, it just doesn't seem right. So I know I'm on the edge of conspiracy theory type of stuff there, but um, those are the types of things I've seen. And I've been trading options for over 20 years. I know a lot of retired market makers and floor traders, and I know a lot of working market makers and floor traders. And I can tell you, you don't get the same story from somebody that's currently working from somebody that's retired. So somebody that's retired and they're not working anymore, they tell you a few little little things that go on the floor, intricacies that go on that make you say, hmm. Uh, anyway, you can build the scans in on Thinkorswim. Their platform is programmable, and the indicators, you can put those in there. That would be if I gave them to you. What do you get with the offer? The offer is for discounted subscription, so you can go there, and I think it's really um, pretty self-explanatory when you go through there. There's some information there that might fill in some of the blanks for you on other questions that you may still have. I'm really babbling on here. I'm an hour and 10 minutes, so I apologize for staying so long. I love options. I could talk options for hours upon hours. I really had no idea that we'd been involved this long. I'm sorry to keep you so long. The scan does not require a specific data feed. It just has to have the um, availability for the criteria that go into it. Some do, some don't. So I guess maybe that is there. There's several of you that are asking that. It's a custom scan. There isn't anybody that has this particular scan because I created it. And again, until somebody tells me that they were doing this previous to when I started doing it, I've never seen this before. Um, I've been around options for a long time. It was just something that came to me literally in the shower one day as far as why can't we change this? Straddles, just the concept of buying a call and buying a put and not caring what direction the stock goes. That's just so basic and interesting. But in the end, because of what you pay for the straddle and the way the delta moves, Yeah, you have to get fortunate. You have to have a large move in the stock in a very short period of time, and it has to be on a stock that doesn't break your bank, like Google would do to pay $7,000 for one contract. And those opportunities are just few and far between. But the concept of being able to put on something non-directional and understanding delta, understanding gamma, the visualization on the curve is what did it for me. I mean, that's where my strengths are, is visually recognizing patterns. And it was just imaging that and the vertical nature of the delta curve. And why can't we take advantage of that? There has to be a way, and there is a way. And that's where this came from. Here's an interesting question. Does it work with the Bollinger Band squeeze? And I was kind of along the lines of when I first tried trading options in the mid 90s. Bollinger Bands is one of the criteria that I utilized. It's not in this scan. It's not in the search. That is the basic the principle. When you see the band squeezing together, showing you low volatility. But you can get a squeeze in a Bollinger Band that doesn't have a specific pattern, and that's the reason that I don't use Bollinger Bands, because you can get a sideways movement in a stock, right? And the Bollinger Bands will come together. The sideways movement is not what you want. That's the last thing that we want. We want a breakout. We need the triangles, and we need a stock that's going to make a significant breakout. So the question, the basic premise, yeah, when you're seeing something with low volatility, but we have to have a trigger. We have to have something that's showing that it's about to break out as well, not just the fact that we're currently showing low volatility. That's the key. Can I repeat the expected breakout ranges in the wedge? Yeah, when you see the mouth of the triangle, measure from the high to the low. So from the high to the low, how many points is that? 75% of the time when the stock breaks out, and the example I used was, let's say the high to the low, and the mouth is the wide part of the wedge. The high to the low is 10 points. 75% of the time when the stock breaks out, it's going to move 10 points. And then it's just going to stop. It's crazy how well this works. I mean, I see it all the time, and it still amazes me. However, 90% of the time, it's going to break 80% of the mouth of the triangle. So if the mouth of the triangle is 10 points, 80% of that is 8 points. So in our alerts, we're going to use an 8-point as our target. And when we send out the alerts, you have access to the website, all the education that we have on the website. You're asking what come, all that stuff comes along with a subscription, and you get an alert and an email, a phone, a text alert, or an email, or both, whichever you prefer. We don't care, whatever is easiest for you to get the information to you. And then on the website, there'll be a detailed analysis with a chart showing the pattern that was identified and where the expected targets are, and to keep you posted on what we're doing. If there is an adjustment, if we do allow more time for one, that type of thing. So that's all available. Which charting software do I personally use? Again, I just careful not to make specific recommendations regarding brokers or software, but I use Integrated Investor, is one that I've used for a long time, by the Hub organization. They're based in Australia. They got bought out though. Schwab bought them, so they're not really doing much to upgrade things. There's one that you may want to take a look at, Trade Navigator. Um, They've got pretty nice, very similar looking charts. I like the white charts with the black lines on there. Um, I look at Thinkorswim a lot as well. Will we ship a DVD to Singapore? And we actually do have this on DVD, and we'll ship it wherever you are. If you want it, we'll get it to you. I say that. I should probably double. Why don't you send an email to support@optionaxiom.com? I don't want to give you misinformation. If you have any email questions or any specific questions, you can email support@optionaxiom.com. They can give you the answer for that. Several of you are asking questions about the offer, and I really think that if you click on the link, it's really self-explanatory there. Will these work on weeklies or a 60-minute chart? Talking about that, I would be on a 60-minute chart. If you wanted to tie something in with a weekly on a 60-minute chart, I haven't done that. That's an interesting thought process. Um, Again, I'm kind of a creature of habit. Anybody that knows me, the people that traveled with me, I eat the same thing. Why don't you try something different? Because I know I like this. So I've stayed pretty true to this basic formula. I'm open to the fact that there are variations that could work. To me, it would depend if it's a 60-minute chart, as long as the pattern's big enough. Here's one last piece, and I'm going to let you go because I've been babbling on so long. And this will go along with your question of would it work on a 60-minute chart. You want the breakout. This is what works best. You want the breakout. So let's go back to that example where you have a 10-point mouth of the triangle. We're going to work on the 80% of that. So we're going to look for an 8-point breakout. You want that breakout to be roughly 10% of the stock price. In other words, if you've got a 10-point wide triangle, and we know 90% of the time it's going to break 80% of the mouth of the triangle. So again, our target breakout is 8 points either direction. That 8 points needs to be around 10% of the stock price, meaning that the stock price should be around $80. A stock that's trading around $80. So you want the breakout to be somewhere in the neighborhood of 10% of the stock price. So as far as a 60-minute chart, my concern would be, is the wedge wide enough for the particular issue to make it worthwhile on the movement to generate. Now, if you were willing to take smaller profits, then that would be something up to you. If you wanted to take, a 10% gain and move on or something along those lines, you could consider doing that. Again, I have not specifically done that. I'm just, thinking out loud here based on your questions. This is another thing that I would really like to clarify too. I was just asked that I used to speak for Better Trades. Believe it or not, there's another Rob Roy out there that's in the world of options, and he spoke for Better Trades. That's not me. I'm a different Rob Roy. Not the same guy. He used to be with Wade Cook years ago. Moved over to Better Trades. It's amazing that there's two people with the name Rob Roy that are I don't know. I think it's kind of a little bit of a unique name. I'm a descendant of Rob Roy McGregor, and so no, it's a different person. But I'm glad you asked so that I could clarify that. All right. Again, thank you so much for your attention. Thank you to Raleigh and Trading Pub for having me. I hope you found that as a worthwhile use of your time. In the end, the most valuable thing we have is time, and I want to make sure that when I'm occupying your time, that it's of value. So thank you very much for your attention. Appreciate it. Hopefully they'll invite me back. I'd love to come back and talk about some of the other strategies that we do. Take care, everybody, and very, very happy holidays to you and yours.